First of all, I want to thank everybody on the call for taking time out of their day to come listen to our weekly chat. And, a couple things are going on, obviously, in the world. And we're going to, touch on those a little bit. But, the first thing that, when I was putting this together last week was before Ukraine or Russia invaded Ukraine, right? And I've seen some video clips and news clips, and it's just awful. I couldn't even imagine, living in a place where you're just being overtaken. So be thankful for where we live. Hopefully peace will come soon. But it is really scary to see. Part of what I was thinking about as I was building this out, traditionally over time, we have heard through, theory that as we want to invest in the marketplace, that we want to have a certain amount in equities, maybe a little bit for cash and a little bit of bonds. Now, as I've talked about that especially over the last few years, I have absolutely been hammering having bond alternatives. And the reason why is because, we were on what is referred to as a 30-year secular bull bond market. It's a mouthful. Basically, that meant that bonds had been doing well for 30 years. But that party is over. And now what you will start to see, and we hear it every time you turn on a TV or a radio, inflation. And if you're not hearing it there, you are absolutely seeing it either whether you're stopping in the Wawa, stopping at the gas pumps, and that's called inflation, right? So bonds don't like inflation. And if you're looking at your 401k statement at work, if you're looking at your brokerage statement and you see that bond area that was supposed to be safe, and you're seeing a decline in value, that is why. They have an inverse relationship. So a lot of what I'm going to talk about here today, is having a strategy in place of what I have referred to in the past as a bond alternative, right? There are a couple things that you can do depending on, what you're willing and able and desiring to do. But one is something fixed or fixed indexed annuities. Right. So when I've done, classes up at Rutgers, I'm actually got a call into them now. But when I've spoken to crowds up there, one of the things that I will normally say in a classroom environment is, we all remember those commercials, Ken Fisher will say, I hate annuities and you should too. Right. Now, little did do most people know that he used to be a majority or at least a large stock shareholder in some major annuity companies throughout the U.S. But the types of annuities that he was talking about is something I will touch on. But annuities are just tools. They're neither good or bad. Just like a stock is a tool, it's neither good or bad. Just like a bond is a tool, it's neither good or bad. If we're going to put money in a place we're looking to get a rate of return, something that is predictable, something that is, reasonable, and something that can, if we can, take as little risk to get as high a return as we possibly can. That's typically the goal. So an annuity is one strategy, right? Another strategy is something that I haven't talked about in a while, but something called structured notes. And these are basically a lot of the financial institutions, Goldman Sachs, Bank of Montreal, Citibank, that's their version of an index annuity. And they can be designed for just a lot of different combinations to create something for people. We've just gotten our structured notes for the month of March. For the American style, I believe it's 12.9% for a 1-year note. And then for the European style, it was a little over 10%. Those are a different type of strategy, right? But depending on the tax environment that they're saved in could determine, the amount of tax that we will pay the following year. Annuities have a unique benefit that any taxes earned are deferred until you take income out of it or you actually cash out the annuity. A structured note, if it's in an IRA, would have that same feature. But if it's in a non-qualified account, it doesn't have the ability to defer that taxation. So just like a CD, you would get a 1099 the following year. And then the last and often overlooked, I think I recently talked on here about the book I put out. I've had a lot of folks wanting to talk about LIRP, which is a life insurance retirement program, or Kaizen. There's a couple of videos you'll see out there, either through some of my channels or on LinkedIn or Facebook. But key word in that sentence, properly structured. See, a lot of people, they think they understand life insurance. They think they got to die to use it. Again, it's a tool that, when properly structured, can help in environments like we're seeing the volatility in the last week, in the beginning of the year, the ups and downs, that it, for lack of a better term, it can be a volatility buffer. So as the market goes up and down, maybe the market's down and you need money. It's a good place to go to get money until the market recovers. And typically history has shown it will recover. So I want to just touch on that because, as we're strategizing, part of, I think it's really, really important. Don't panic. I've already had 2 or 3 phone calls of people saying, hey, should we do anything with the market like it is? And my answer is no, right? What you have to remember is that the market typically already has this information baked in. What I found really, really interesting is that no sooner had the events in Ukraine happen and the futures were down, the market was down, 600 points. And I mean, literally, market open, market's down, and there was a news blurb. Right? Oh, market down, 400 points, 500 points, 600. It's like immediate. If you want to find out what's going on in the world, I strongly encourage you to read the newspaper or read an article versus watching some of these news outlets that are just 24/7. And remember, they just function on fear and greed and something that, seemingly seems like it could be the sky is falling. And in the case of the Ukrainians, yeah, it is. But as it affects us and our livelihoods and what we're doing here right now today, it doesn't affect us. And it's really not going to affect, if you're looking at your 401k statement online at work every day, every second, like, oh my God, relax. It's going to be okay. And we've talked about that before. They're going to have dips. There's going to be corrections. But if you're still working and you're adding into that every week, you're buying it on the way down. So we're going to talk about an annuity today. Specifically, Allianz has put out a promotion, a 35% bonus. But before I get into that, I think it's just really a recap of understanding, people hear about annuities and quite often will say, well, do you know what an annuity is? And quite often they'll say, yeah, I think so. So in a Reader's Digest version, what I say is life insurance pays if you die. An annuity pays if you live, regardless of how long. So on the left side of the screen, you're going to see the line on the middle. You'll see immediate, right? And on the right side, deferred. Let's talk about immediate. I want you to just think of an immediate annuity as an exchange or a trade of cash to an insurance company for a promise to pay for regardless of how long you live. So let's think about it. Let's say that you have $100,000, and you said to the insurance company, "I'm going to give you this $100,000, and I want you to pay me a check next month, regardless of how long you live." They will do that. It's just like a pension. That's called the life only. Right? So if you turn around and you take 100% payout, now this is why they get a lot of negative press, because people hear this component and they go, and this is also another word that you'll hear in the industry, it's called annuitization. You're actually annuitizing the annuity. You're basically saying, I'm giving up all control to the $100,000. I don't want it. Insurance companies send me a check every month, deposit money into my account every month, regardless, and they will do so. But if you take in cash that check for the first month, and then let's just say in my example, you got an $800 check, and you turn around and passed away, so you cash that in February and passed away in March, they would keep the other $99,200. Right? So a lot of people go, well, that's not a good deal. That's awful. I would never do that. Okay, I get it. But the other side of the equation is if you made it to 121, they would pay that $800 a month for life. So the question is how long are we going to live? And none of us know, only the person upstairs. Right? Now, there's also something where you can go, well, I want to get that life only, but I want it for a period certain. That could be 10 years, could be 15 years, 20 years. I at least need to get that money for 20 years. Well, instead of giving you $800 a month to give you that agreement, maybe they only give you $500, but they guarantee that that $500 is for a period of time. Then they can do life only with a spousal benefit. Maybe they're not giving you $500, they're going to give you $400 to make sure that your spouse has the ability to live on that money should you pass. And then, it just goes on the combination. And my point is that immediate annuities are very rare, right? I typically don't see them. The only time that they really apply is if you're in a system that has a pension offered, and people will bring in their statements and I'll say, hey, this is what that means. This is an immediate annuity or a pension, right? But what we're going to talk about is a deferred annuity. A deferred annuity, and the first one I'm going to talk about, variable, and this is the one that I was talking about that Ken Fisher used to talk about, that I hate annuities and you should too. And the reason is that variable annuities are, if you put in $100,000, and quite often they're misrepresented by advisors, and even sometimes some of the commercials can be misleading, right? Variable annuity. So, hey, you give them the $100,000 and you can be in the market and get all the upside, and we'll put a rider on here and you're guaranteed 7% and blah, 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 blah. And then turn around, the market corrects 30%. You only got $70,000 in your account, and now you're trapped and you can't get it out. Not to mention that fees could be anywhere from 1.5% to 4.5%. Very, very expensive. I don't like variable annuities. And I quite often, when I see folks that have them and I peel back the layers and help them understand what they have, I say, hey, is this really what you want? But the other types of annuities, and these are, I think, are tools that are just quite often overlooked. But in environments like now where you have a lot of volatility, this is where we can have that bond alternative. We can have a little bit of certainty where there's question marks. So in the fixed annuity world, there's either MYGAs, which stands for a multi-year guaranteed annuity. It's like a CD, right? You can say a 2-year annuity, a 3-year annuity. We got MYGAs right now that are 3 years that are paying 2.3%. Right? I mean, that's better than any CD that you're going to get right now, right? And the tax is deferred. Instead of paying that tax every year, it's deferred. So it's an option. But the fixed index annuity, this is the one that I think sometimes can be a tool that, as part of an overall plan, can help folks to have that peace of mind that we can still be in equities. We could have 60% in equities in different indexes. We could have 50% in equities as we approach retirement, and still have the certainty that, hey, I sort of have that buffer, that sort of floor that I can make sure I don't go backwards. And then when you add indexing to that, right, now we're gaining upside potential. So Allianz 222, this is one of their number one leading products, and I've offered to clients, for decades now, right? So coming into 11, 12 years of being around. Real simply, you get tax deferral, as I talked about. You get index interest potential, right? So what does that mean? It means that depending on the type of index that you picked and the crediting method and all stuff that I'm not going to get into today. If you want more information, just understand that this bonus that Allianz is offering, and a lot of you I've sent out the email to, is only till I think it's April 11th, right? So it's a very short window, like 6 weeks. And then the bonus will go back to what it was, which is like 25%, right? This is the highest I've ever seen it, right? But then it's also protected contractually with a world-renowned insurance carrier. So who might be interested in something like this? And here's the thing, with this specific product, not every annuity, but this product, I had a couple people that have reached out to me and said, Chris, should I look at this? And knowing what I know, I said, listen, you might need money sooner than 10 years. And if that's the case, this is probably not the product for you. But if you are sitting in the audience today, or you know somebody, maybe your spouse, significant other, somebody that you work with, and you say, hey, listen, you know what? This might be something where you can do something called, quite often 401ks at work allow you to do an in-service distribution, right? So it's going to be a trustee to trustee transfer. You're going to go from your 401k. You can take the money that was in your bond portfolio, reduce that risk by moving it into your own IRA. And in that IRA would be the Allianz annuity. So, but remember, you don't turn on income until year 11. And I'll give you an example of that here shortly. So if you're looking for principal protection and tax deferral of any growth, combination of guarantees and the opportunity for upside potential. It just really is one of the lowest risk ways that I know to accumulate money on a long-term basis. And then flexibility to change your mind. So, I have one client that, as their circumstances are changing, they're like, hey, listen, and I did this annuity for them 6 years ago, right? So they're like, hey, listen, I'm thinking that I might need some cash. Well, we can go in and take a portion of that money out. So there's always a liquidity feature, potential for increasing income. That's really a cool feature of a lot of annuities that promote it from an income stream standpoint. It's static, just like, the pension. You go, oh, well, you're getting $3,000 for the rest of your life every year, right? And it's never going to go up. But with this, you have the potential to get upside potential on or an increase in the actual income. And you could benefit from the premium bonus and interest bonus. So before I get into index lock, what I wanted to show real quick was an illustration. And if you guys can still see that, again, this is hypothetical. It's a value client. I ran it today just so you could see that, when we come over here, because there's a lot of data here. And if you want to see what something would look like, the first thing is, depending on when you turn on income, will determine on how much of the percentage you owe. So if, let's just say you had 100 grand for a single person, and at the end of 10 years in year 11, you say, I want my single payment. Well, you'll get 4.5% as your payout in that year. Joint payout. So this is why I do like it. If in a qualified plan, if somebody has an IRA and they put it there, and you turn around and you're chugging along and you were getting your payment streams, and the person who the annuity was on passes, the spouse can continue the payment. So that's what this banding means, and the distribution rates out of the PIV value. We're going to get into that. So these are just the indexes I use. But what I wanted to point out here is, listen, I just said, hey, if you were 55-year-old, and this was a male in this case, $100,000, depending on what the credit was, and they got the 35% bonus. So notice that the accumulation value at the end of the year was 101,702. So that was a credit to the account, their 100 grand. But it's this number, the PIV number, the 138,447, that the income is based on. And the reason that's important is because this number right here can't go backwards if you're until you start to take withdrawals out. So it gets locked in, right? But it is not walk away money. That's the one thing I want to make sure everybody understands. If you turn around and go, hey, send me a check for 138,447, well, there would be surrender penalties in the first 10 years. But if this was in year 10 and this was your account value 101,702, right, you're going to always get the account value. So I just wanted to point that out to you so you can understand. But as you start to turn on income, notice that this income is going up. In year 11, it was 10,298 in this example. I mean, some years are 2.5. I mean, what this is based on is the last 10 years. So I don't know what the next 10 years are going to look like, but we're going to have ups and downs. But having the ability to participate in the market, so you get the market, right? So in this case, this index with the participation rate got 10.8%, but it's got 150% bonus. And that's why it got 16.25% credited to the PIV value. Ultimately, when it got down to the distribution rate, you start seeing that, hey, once you get in, you make your 10,000, you can never earn less than that if that's what you got. But let's just take this year where you got a zero. See, it went 14,445 and it went 14,445. You're never going to get less than that. But the next year, when you get a bump, you'll also get a pay raise in that. So that's another really cool feature of this annuity. So back to the program. And again, I just wanted to help sort of put it in perspective. If you want to see what an illustration might look like for you, just send me an email at the end of this and I'm happy to run one. So index locks, this is something neat that Allianz has generated. And I've had over the year, right, actually 2 years now, some of my contracts that clients have been in, that they turn around and I get notified saying, hey, right now they can lock in at 12%. You can do that anytime during the year. You can set the floor at the lower target and you can put the upper target. It can do an auto lock. You can manually lock it. It's just a feature that if the thing is getting bonuses and then we turn around and have something like Russia invading Ukraine where all of a sudden, all the indexes are falling that it was tracking with, you could say, hey, listen, maybe in December when you're at, 10 or 11%, you go, that's good enough. I'll take that right now. So it's a feature that Allianz offers on select indexes within that. So again, anybody that has interest in that product, just let me know. But bottom line is the Allianz 222, which came out, which I thought was ironic, on 2/22 of 2022, the Allianz 222 offers two ways to receive a bonus. Right, so that's not only in the form of a 35% bonus right now, as well as the bonus on the index credits. You also get two ways for potential increases in lifetime income, right? So the withdrawal of that income, and then two ways that the beneficiary can receive the death benefit, meaning that if they turn around, somebody passes, they can take a lump sum or they could continue the income stream and pay it out over time. So the last thing here is, what is that PIV value, which I showed you, and that's why I wanted to show you the illustration first. It's really that bonus account. It's sort of that sort of fake money, if you will. You're never going to get the whole full value of that, but that's what they're deriving from an actuarial standpoint, how much of an income you're going to get. But the income withdrawals can begin after 10 contract years between the age of 10 and 100, and they're automatically included with no additional fees. So, it really is a strong product. I think if you're looking for a little bit of peace of mind, maybe you weren't certain how things work, just, hey, give us a shot. We're happy to show what something might look like for you. But, as far as a company, they're really strong, right? One of the strongest insurance companies in the world. And I've been very comfortable with offering these to my clients over the years. So that is the end of my slides. I want to just say, I think I probably forgot my disclosures there, but says that I didn't make up any of this stuff. I am a member of RWA, and that's a registered investment advisory firm. And I'm part of, Producer Partners, Eagle Team Financial Pros. And this is my email and phone number. And so if any of you have any questions, I'm happy to help in any way that I can. But I just really want to say, hey, look, don't panic, right? The market, it's going to, like I mentioned last week, it's going to go up, it's going to go down. I know right now, hey, listen, if I start getting indicators that it's going to continue to go down, then I might have you move to the sidelines, right? But I am not going to be reactionary, right? I will see what our CIO and our investment teams, what information we're getting, and then I will share that with everybody here. So if anybody has any questions, again, please reach out. I wish all of you well. And let's say a prayer for the people right now in Ukraine, because I just can't even imagine. So I hope you're all doing well and have a great day. Bye-bye.